A lot of people are very intimidated by getting started with investing. Some people might even be worried that they'll end up penniless and on the streets and outside the donut shop turning tricks for a nice maple bacon bar. No? That's just me. Whatever, you do it. I'm going to share 7 beginner investing mistakes with you today, and I have either made these mistakes myself or seen people who are really close to me make them. So hopefully this video will help you and you won't end up broke and penniless and lurking outside of Dunkin' Donuts like a sugar-crazed creep. So hold on a second here, because now I'm thinking about it, and you guys, am I the only person who imagines these weirdo disaster scenarios when bad money things happen? Because I feel like I'm probably not. What are yours? Tell me what yours are. What's your worst or weirdest fear that will happen if you make a bad financial decision? I'm super curious about this. Also, I kind of want to know if I'm a weirdo or not. So let me know in the comments below. Let me know. Am I alone in all this? Because I don't think I am. But maybe I am. Maybe I am a weirdo. Maybe you can call me a weirdo. But if you do, at the very least, you got to hit that like button for me so that I can feel a little bit better about myself. I'm Melissa Ford. Welcome to Damsel of Success, where we talk about all things money. Be sure to like and subscribe and hit that bell to be notified when I post a new video, which happens every single Wednesday. First up, I'm just going to give you a little bit of a disclaimer here. I am not a licensed anything. I'm telling you stories here about things that I've seen and my own experiences and that of others, but this shouldn't be constituted as specific financial advice to you. There's always risk involved in investing, and you take that on every time you decide to make an investment. Like I've said before, I'm just some weirdo on the internet, so make sure that you do your research and get a second opinion on any investment advice, but hopefully some of these tips will help you out. Also, I should mention that most people invest because they're trying to build up their retirement savings, and if you don't quite yet know what your retirement goals are, I can help you out. I have a free calculator, which I will link below in the description. It's, you can just download it from my website. So I'll show you where you can get that in the description below. So let's get into these common mistakes that beginner investors often make. Mistake number 1 is trusting somebody else with your investments. I see this a lot, particularly in couples. And being in a couple is great because you get to leverage each other's, expertise in different areas. And inherently, just to make your lives efficient, you end up taking on responsibilities that only you handle. And oftentimes I see that happening with finances. It's not a huge deal to have somebody be primarily responsible for that. You may not be the one setting up all the bill payments or making sure that the budget is balanced, but you should absolutely know where your money is, where it's being invested in, and how it's doing. And you need to bring a little bit of knowledge to that table. Because I think, we've all seen relationships go awry, and I don't think anybody goes into a relationship saying, oh, this isn't going to last forever. And yet we have a lot of divorces. So I think it's just smart. It's just the smart thing to do to make sure that you know what's going on with your money at all times. Because, I've seen a lot of tricky stuff happen with money once, things get contentious in a relationship, or God forbid that somebody, were to pass away in the relationship, and, you didn't know where your investments were or how to access your accounts. That becomes extremely difficult to handle. So you might not consider yourself to be the money person in the relationship, but that doesn't mean that you can put all of the responsibility for your financial future on somebody else. It's just not smart. Mistake number 2 is not taking advantage of your company's 401k match. Now, not everybody has a 401k match, but if you do, and a lot of companies offer this, it is really, really important to contribute up to the point, at least, that you're going to get a match from your employer. It can really boost your retirement savings if you do take advantage of that benefit. It's free money. It's your money. It's part of your compensation package. So please contribute to your 401k at the very least up to the point where you're taking advantage of the full match from your employer. Mistake number 3 is treating your 401k or any of your retirement savings as an emergency fund or a savings account. Your retirement savings is meant to be used at retirement. It's not meant to be withdrawn before that. when you do withdraw your funds prior to your retirement age, not only are you robbing yourself of future gains that could be made while that money is just sitting there and growing over time, but you'll also get hit with some significant fees. And those fees vary depending on the type of account, but they are not small and they absolutely will impact your long-term savings goals. So once you begin to contribute to a retirement account, just put that money out of your mind. It's gone. It's not available to you for any reason whatsoever. Let it grow. Let it take care of you when you retire. Okay, on to mistake number 4. And that mistake is investing in something that you don't understand. Now, are you going to be able to understand every investment like a financial advisor would who studies these things? No, I don't expect that of you. I don't expect that of myself either. But if you can't, in a sentence or two, tell somebody else about what you're investing in and why it makes sense to you to invest in it, then it's not an investment for you. So funny story, literally a half an hour before I started filming this video, I had a conversation with some people who were talking about a family member who had given them some insider stock tip. And that's really, like, that's super dangerous. Almost never are those things a good idea. And if somebody can't tell you why it is that this is such a good idea as an investment, particularly from a business standpoint, not from an opportunity standpoint, like I heard it from this guy who heard it from this guy, like never ever take those stock tips, not ever. The point is that if you don't understand it, then it doesn't make sense for you to put your money into it. And it doesn't take a great amount of understanding. Like I said, I don't hold myself to a particularly high standard with what I have to know about my investment accounts, but I've done enough research that I'm comfortable with those investments. And I understand the basic terminology around what those investments are. And I have a book recommendation for you if you're looking to just get like a baseline level investment strategy that is simple and straightforward and that you can understand and explain on this level, then I would highly recommend that you pick up a book called The Simple Path to Wealth. That book is by a man named J.L. Collins, and he started writing this book as kind of a letter to his daughter about how to invest. And it turned into a full book, and it's so good. It's an easy read. It is very straightforward, and I think it gives some of the best investment advice out there, particularly if you're just starting out. So pick up that book and just take a quick read of it. It's a fast, easy read. I will put a link in the description below so you can find it super easily. But the point here is just to get a little bit educated enough about your finances and about your investments, because you never ever want to invest in something that you don't understand. Mistake number 5 is trying to time the market. What is proven to be most effective in almost every case is to steadily and continually contribute to your retirement. And that is a technique called dollar cost averaging. And what it means is that you're just consistently every month putting the same amount into your retirement accounts. So sometimes when it's down, you're buying when it's down. Sometimes when it's up, you're buying when it's up. But overall, you're building a habit. You're riding with the market with its ebbs and flows and not letting any one dip or surge affect your bottom line. The reason that people have so much trouble with this is that investing in your money it can be a really emotional thing. So when we see things like, the market getting affected by the current situation that the world is in, it is real easy to get scared and sell everything because you see that market going down. And that is a big mistake. It's a huge mistake. And if you guys want, we'll go into this topic a little bit deeper about why it's a bad idea to sell your investments right now. But the idea behind this mistake is that you have to have a mindset that you're in this for the long haul, because those are where the major gains happen. It's not that you're going to time perfectly your sale or your buy of an investment, because that is an impossible thing to predict and you really don't know. So you have to have a long-term mindset about your investments and make sure you're just in it for the long haul. This next mistake I've seen a ton of people make. It's a really, really common mistake to make, and I myself have made it. So I'm hoping that I can help you avoid making it too. Mistake number 6 is thinking that one good investment outcome means that you're good at investing and not just lucky. And I think this is particularly true. I'll tell you what my story was with that, is that I picked an investment, it went up over time, and I was like, yeah, I totally, I know what I'm doing. This is great, you know? And then I talked to a friend and she's like, well, yeah, the whole market went up over that time. And had you invested in something else, you would have had a much larger return on your investment. And I was like, oh, okay, duh, right? But a lot of people get trapped in this mindset that if they see their investments go up, that means that they're doing everything right and everything is fine. I mean, that's good. It's not a bad result, you know, when your investments go up, but it doesn't necessarily mean that the actions that you took to get there were the right actions. And that kind of concept comes from another book, and I'm sorry, I can't remember the name, but if somebody does know, put it in the comments below. But this is a book about a woman who, she was in gambling. She did poker, I think it was, and she had to really learn how to separate the actions she took to get a result from the result. And that same scenario applies not just to poker, but also to investing, because there is an element of chance involved in both scenarios. And what you have to do is just pay more attention to the actions you're taking than to the result itself. And when I say pay more attention to the actions you're taking, that means coming up with a plan for investing, sticking to that plan, and watching it, you know, grow over the long term. So for instance, if you were to just throw $1,000 at an investment that you hadn't looked into, but that somebody, you know, down the road said, oh, you got to buy this right now, and it turned out well, that's great, but it doesn't mean that the actions that you took to get there were good and are going to result in good returns in the future. So you just kind of have to separate out those two things. It's a different thing. The result is a little bit different than the core actions that you need to continue to do to get consistently good results. Just something to keep in mind. On to the 7th and final step, which is to delay investing. And this one is a really easy one to do because it requires you do nothing at all. So, you know, simplest possible thing that you could do. And I've saved it for last because I want to end on this note here. And that is that the worst thing that you can do for your investments is to not invest at all. You're gonna make mistakes. That's just part of the game. You're going to lose a little bit of money, but most of the time, what you're going to find out is that those lessons are worth so much more than the money that you lost on them in the beginning, because they're teaching you how to grow as an investor. And anything that does that is just going to increase your bottom line. So I'm going to give you some terrible advice right now, and it's terrible for me, it's not terrible for you, but that advice is to stop watching YouTube videos and researching and just go invest already. Well, I mean, maybe you don't have to stop watching my YouTube videos. I mean, you could definitely, you know, watch all of them and like them and subscribe to my channel and, you know, tell me in the comments how you think we could probably be friends, because we could totally be friends, right? Obviously we could totally be friends. But after you're done with that, then turn this off, go open an account and get started. It's the most important step that you can take. And just a quick reminder that if you're trying to figure out how much you need for your retirement, I've got an easy calculator that'll help you do just that. You can download it for free on my website. I'll put the link in the description below, and I hope you take advantage of it if you need it. If you like this video, please hit the like button. I would really appreciate it if you did. It helps me out a lot. And if you loved this video, please subscribe. I'm going to be putting out more videos on how to reach your financial goals, and I don't want you to miss anything. So subscribe, hit the bell to be notified when I post a new video every single Wednesday. I'm going to be here, and I hope you will be here too. That's all for now. Bye.